Good day, everybody. Brian, welcome here to yet another analysis that I'm now able to provide in my deep analysis service. You want to know more about this? It's very critical. You join our email list at quantlabs.net/books. I'm going to educate you on what's going on with the gold market versus the stock market. Where are you getting better performance? Now, this chart or this pretty well professional. These are the tear sheets that portfolio analysts, institutional level, will look at for all these different metrics. I could go through each one, but it would take days and years to go through. Essentially, I'm going to show you what I look at that's important to me. So quite clearly, we are using our benchmark here of QQQ. Okay, we're also got a strategy, a batch of ETFs that are purely on gold. And these are the only ETFs of the last year that are profitable the last year. So I want to show you how they performed and why you may not want to put as much money into gold as you think. Because if you're like one of those flat earthers waiting for the calamity to come, and then the day you can go out and celebrate when gold is now the king and everything else has been decimated, as long as the US has the capability to print money and solve all these crazy uh, debt ceiling problems, uh, stock market probably will be your place to be if you know what to look for. Anyways, what I want to show you here, this is pure gold in blue. Here's its Sharpe ratio. I just put up a video on Litecoin alone, which is crazy volatile. That was um, that was 55.55. So gold is not as good for the last year uh, than uh, than crypto. Now it's just Litecoin only, but this is just a high level comparison. You can see here it's very important to understand that gold still lost money last year, um, quite quickly, but it did do well up until a point in last year, and then just took a major dump. So if you're one of those people that just do buy and hold, gold is not really a good investment long term. As you can see here, it was here, the return, and now we're back to it now. So the markets did here obviously outperform. They were in line, and this is what you really want to avoid is to avoid this kind of relationship between, let's say, gold and should say gold ETFs and the ones that are picked out with the positive returns, and the stock market generally like the QQQ. So what I'm saying here is that gold is not what you think it is. If you have a heavy concentration of gold in your portfolio, you're probably not getting the kind of returns that you get with something else. So I'll show that in some examples, but I'm not going to show you the best of the best, obviously. But there are really good ones out there, just unbelievable returns. So again, you want to know more, just join here at the email list, quantlabs.net/books. All right, so knowing all this information, right, you can see here that the benchmark is just blowing the doors off of the overall gold mix of ETFs we've got. And again, those are the ETFs that are profitable with a positive return for the last year. Okay, so this is goes into really big detail. Okay, all the detail, but the essential stuff here is this right here. So if you're looking at the more positive things I can say about gold, they don't have those deep drawdowns that you can get with, let's say, crypto. That is tolerable in July of last year. But you can see it still was negative each month and then went positive again. So gold, this gold is fairly volatile. Um, this year it's been doing okay with a negative month of February, but as you can see here, as I showed earlier, you get double your return with the Qs versus gold of what I've got here. So understand that. Now, people will say that's all smoke and mirrors, that's all BS. You can say what you will. This is raw data. I'm not manipulating this. This is just as I said, professional tear sheets, uh, pulled out from positive returning ETFs that focus on gold that are available on interactive brokers, and you can see they do okay, but not great. Now, there are other elements, areas in the U.S. stock market that have been doing pretty good for the last year. Um, and we'll just leave it at this. But the ultimate comparison when you do this is always, always, always what the professionals use as a Sharpe ratio. Okay. I'm not gonna go over all the others, okay? But right now, this is important to know. Okay. So as I said, you do what you want with your money, but if you want to get real decent returns, you want to learn more about this because that's what it's about is getting optimal returns. Okay. So you can let your ego run you and have subpar returns or follow something like this, which is using again raw data. All right, so we'll leave it at that. Thanks for watching. Have yourselves a good day.